Good morning, everyone, and thanks for joining us this morning. I'm Tim Wood, Chief Executive of McInroy Wood, and with me today is Guido De Cocchi, our Director of Investment, Liz Wild, our Investment Director based in Harrogate, and Jamie Nibbs, our Investment Manager. Also with me is Isla de Haldevang, our Client Administration Manager, and she'll be asking us questions today. I've been delighted with the level of engagement, and thank you all for those questions that you've submitted already. You can also submit questions live during the event on the chat function, so please do feel free to do that. We'll try and answer as many of those as we possibly can during the course of this webinar. If we don't have time to get to any of them, somebody will come back to you with an answer to that question shortly afterwards. I'd like to reassure you that all the questions you submit, and indeed all the participants today, will remain anonymous throughout. We're recording this presentation and we'll make it available on our website shortly afterwards, probably in the next day or two, for those of you that either can't stay for the full event or indeed for those who want to watch it another time as well. As always, please do provide any feedback that you've got. We can only improve these sessions from you telling us what we should be doing better, or indeed areas which we may be covering as well. As a firm, McInroy Wood continues to reinvest in its business, and we're always aiming to try and carry on improving what we're doing for you, and indeed the level of service we provide to you as well. We're delighted that David Cruikshank, the ex-Global Chair of Deloitte, has now joined as our chairman and indeed has received his regulatory approvals as well. We continue to hire junior members of staff and bringing them from the bottom up through the organisation, utilising our training programmes and also offering them long-term career prospects, which ultimately benefit our clients, for people who have been here for a long time. The business remains financially strong, and we continue to absolutely cherish our independence. Merger and acquisition activity in our sector continues apace, but we really feel strongly about our independence and indeed the benefits it brings to you. So Guido, we are in economically testing times, and inflation poses a major threat to the global economy. Perhaps you could briefly start by telling us a little bit about what we've done in portfolios to address this threat and bring us up to speed on what our actual investment outlook is.
Thanks, Tim. So Tim and I discussed inflation at our webinar in February. Since then, Russia's invasion of Ukraine and strict lockdown measures in China have contributed to a spike in food and energy prices. As a result, central banks have brought forward their planned interest rate rises, and governments are also keen to bring living costs under control. The possibility of an economic slowdown has increased materially, and we're cautious about the short-term outlook for companies and their profits. Equity markets have been weaker, and bubbles in some parts, such as technology stocks, have been pricked. However, valuations still do not fully discount weaker demand and higher finance costs. As a precautionary measure, we recently reduced the target equity allocations in our mixed asset portfolios, such as the Balanced Fund and the Income Fund, by 10%, from 65% to 55%. Nevertheless, we remain optimistic about the long-term future. One of our jobs as investment managers is to identify and support new technologies in areas which will help address challenges such as climate change and water scarcity. Ultimately, holdings in soundly financed businesses with genuine pricing power still offer the best opportunity to grow portfolios and protect clients' and investors' investments from inflation. We recently published an article discussing environmental, social and governance, that's ESG, issues in investment management. Increased publication of ESG data is helping us and other managers to monitor our investee companies more closely. But ultimately, it is the qualitative impacts of businesses that are more important. Ethical considerations and careful stewardship have always formed an integral part of our investment approach. As part of our stewardship activities, we prefer to act as concerned shareholders and engage with our companies on a regular basis. And typically the companies which operate in a way that is sympathetic to the wider interests of society deliver the sustainable and long-term returns that we're looking for. And with that, I'd like to turn over to Isla for the questions and answers.
Thank you, Guido. Well, welcome to the question answer section of today's webinar. I'll be asking the panel a number of questions, some of which have already been received by us and some we are hoping to receive during the next hour. So the first question to you, Tim, if I can ask, is the inflation genie out of the bottle? And if so, will central banks be able to contain it?
Thank you, Isla. Well, the first part of this question is a very easy one to answer. Clearly, the inflation genie is out of the bottle. The inflation across the Western world is running, if not at, near double-digit figures. And that is something that we haven't experienced for a number of decades. So it is clearly driven by, firstly, some short-term factors which were unexpected, such as Russia's invasion of Ukraine, which has driven up energy prices. But the inflationary pressures were already there long before that happened, and we would be worried about inflation for some time. Primarily, it stems all the way back to the financial crisis and the policy thereafter of very low interest rates and cheap money has effectively created asset price inflation. It's something that we've written about and talked about at length. So the central banks now face the major problem of how to solve inflation and how to get inflation back under control. And they have different mandates. In the UK, it's just to control inflation within a certain band. In the US, the Federal Reserve also have a growth mandate too, as well as that of controlling inflation. So the biggest conundrum they've got is how to get inflation down, which obviously means typically raising interest rates and reducing stimulus in the economy without creating a recession. And it is an incredibly fine tightrope that they walk in doing so, and the likelihood of them being able to engineer a soft landing economies without triggering a recession by bringing inflation under control, we think is quite unlikely. We think there is significant room for miscalculation. And therefore, making sure in our portfolios and our role as investment managers that we are trying to position the portfolios not only for where we thought we'd be today, which is in an inflationary environment, but where we think we are going to be in a year's time, in a couple of years' time. And we think that inflation may well be here for some time to come. Also, the biggest threat and the thing that we're watching most closely now is the impact of wage inflation and how wage inflation is beginning to take off. We're seeing it in the public sector, where unions are increasingly declaring strikes and making higher wage demands. That's not just here, it's also in America as well. But also we're seeing wage inflation starting to kick in the private sector in quite a major way too. And once that becomes embedded, it is a much, much more difficult task for central banks to gain control of it.
Okay, thank you. Interestingly, this is a question that's come in to Guido, if we can ask you. It's a follow-on, effectively. How are McInroy Wood's portfolios faring relative to markets this year? But with a secondary question, is it realistic to expect the balance fund will continue to beat inflation?
Okay, so the first thing to say is that our portfolios have not been immune from the equity market weakness that we've seen over the last 12 months. To give you a feel for how they've performed, the balanced fund, so that's an international portfolio of bonds, equities, gold and cash, is broadly flat in total return terms over the last 12 months. And that compares to global equity markets, which are down around about 5%, and bond markets, which are down around about 3 or 4% over the same sort of time frame. And what we're trying to do is through our collegiate approach, is to discuss what's going on in the world and come to a conclusion as to where in the world we should be investing and the allocation to different types of investments, whether it's bonds, gold, and the equities, depending on whether we're feeling cautious about the world, as I said earlier on, as we are at the moment, or whether we're feeling bullish about the world. So, although we're disappointed that the portfolio has maybe not done better, in relative terms, it has done well. In terms of looking forward from here and keeping up with inflation, I think it's almost it's going to be very, very difficult for us to do that over a short period of time. The fund is inflation is running at 11% in the UK, and as I said at the start, one of the best opportunities to be able to try and keep up with inflation is investing in companies. But as Tim has explained, we're looking at a situation in an economic environment at the moment where we're concerned there might be a recession, and the last place you want to be heavily invested when you go into a recession is companies. So the reason behind our recent reduction in equity allocations was looking at the preservation of capital in nominal terms. So rather than being exposed to something that might fall in value, that will make it very difficult for us to keep up with inflation over the short term. But what it does do is provide us with a liquid investment that we can then sell and reinvest back into companies when we feel that the outlook is more optimistic, because that's where we are going to get the growth in the portfolio, and that's where we are going to be able to protect over the medium term, so 3 to 5 years against inflation.
Thank you. Liz, this question to you, if I can ask, does ESG investing make sense?
Okay, so part of our job as investment managers is doing research and analysis of the companies that go into clients' portfolios and funds. And as Guido mentioned at the beginning, we've always taken a holistic approach. So whilst we're really interested in the financials, we also start by looking at what a company actually produces. So what is the product, what is the service? And then going through a number of different layers. And environmental and social and governance aspects are really integral to that, because they impact the profitability of companies, they impact the reputation, the future sales of businesses. So it's very much something that we think about actively. Some people think of ESG investing as being a little bit broader than that. But from our perspective, how we handle it is to think about it as just part of the process when we're looking at companies, identifying high quality businesses with good potential investment returns.
And Jamie, I wonder if you might add to this. So what ESG qualities do you look for when selecting an investment?
Well, I think at its most sort of basic level, we want to ensure that all of the companies that we invest in behave well. And so that means ensuring that boards are independent, that executive compensation isn't excessive, that a company has an awareness of its social responsibility and is making steps to improve its environmental performance. I guess the other thing is that as we're long-term investors, we're drawn to investing in companies which are going to be sort of fit for the future, if you like, and whose products and services are going to be in demand in 10 or 15 years' time, when the world might have changed quite significantly. And so that's one of the reasons why we, for example, invest in Air Liquide, which is a French company which has a very steady business in industrial gases, so oxygen and nitrogen, for example. But it also has got growing expertise in the supply of hydrogen, and so that's certainly an area which we think over the next decade or more could become quite significant for that company.
Can I just add to that, Ida?
Yes,
so I was just thinking about another company that we have in the funds and some clients' portfolios called Croda. And so that's an example where you've got a management team who've been very proactive about thinking about the future and their raw material sources. So historically, it was a business started in Yorkshire, would have used petroleum as a raw material. But probably 15 or 20 years ago, they decided to pivot and look at other more renewable sources as their input costs. And that was partly driven by their customers in the personal care area, looking for a more sustainable product to kind of, deliver what they needed. So that's another example.
Thank you for that. That's great, Liz. And please don't forget that you can submit questions during today's webinar on the chat box on the Zoom. We would love to hear more from you. Now, Tim, I wondered if I can ask you this next question, submitted in advance. Has gold in your portfolios done its job?
Well, gold certainly is an investment, a very emotive subject, and it's something that we've been investing in portfolios for a number of years now, mixed asset portfolios. My answer to that question is it has started to do its job at present. And by that, I mean it's actually provided quite a lot of capital preservation within portfolios over the course of the last year or two. And indeed, we have made some money too on it. But it's not there for these smaller moves, these growing concerns about inflation. It is there ultimately if central banks do lose control of inflation. And one needs to go back to the 1970s to really look at the last time that happened. And at that point in time, gold went from a couple of $100 up to several high $100, increased nearly tenfold actually over that period of about 18 months. And it's that level of protection that it's really there for. So it has started to do its job, but we continue to hold it because it continues to have a job to do, quite a material job to do. We hope we never have to use it and we'll never get used in that capacity, because if so, then the worst expectations don't materialize. But it actually having that insurance there from a capital preservation perspective is really important, particularly given the level of uncertainty around inflation over the coming years.
Thank you. Guido, we have been asked, what are the prospects for interest rates from here? And do equity valuations still suggest markets could fall further?
I think the prospects for interest rates are that they're going to rise further. We've seen, taking ourselves back to sort of autumn of last year, central banks were very much of the view that inflation was going to be transitory. It was going to last for a short period of time and then fall back again. And we were saying then that we expected it to be more prolonged, and we've been proven to be correct. And the central banks, as a result, so far this year have raised interest rates in order to try and counter that. And we expect them, the change that we've seen from the central banks and from governments actually over the last 3 to 4 months is that they're more committed to doing that. And as I said in the introduction, they acknowledge the potential impact on economies, but it's of secondary concern to them. They are willing to incur that impact in order to try and keep inflation under control for all the reasons that Tim's explained, and the history of what's happened in the likes of the 1970s. So I think they will continue to raise interest rates, try and reduce demand and try and get inflation under control as best they can. In terms of the follow-up, equity valuations have fallen significantly in various parts of the world, and that's healthy because it's reflecting what's going on in the wider economy. But our concern is that when we're talking to companies and management teams, the expectations for earnings, for profits going forward, we don't think still reflect the likely impact of higher interest rates, meaning people who have perhaps some of the money that they saved up over COVID and the lockdowns, they've been spending that, and that will run out. And we're already seeing signs in certain industries where people are not spending as much money. So we feel that impact has still got, or that trend has still got some way to run. And ultimately what that will do is reduce the profits, reduce the earnings that companies will make. And therefore the price of the shares normally reflects those earnings. It is likely to therefore fall as well. So we still think that there's some way to go in terms of equity markets from here.
If I could perhaps just add a couple of things onto the end of that, Guido. There is no doubt if one looks to historic valuation levels that company valuations, particularly in America, are still above historic norms. And that is in the face of rising interest rates, rising input costs, whether that's wage increases, raw material input costs, and also ultimately rising taxes as well. And these are all headwinds which are compressing company margins. And therefore, in the short term, I think there is going to be continued pressure on company profits and indeed their valuations as well, as that realization sets in. But it does depend upon also the quality of companies in which you're invested and indeed the sectors in which you're invested as well. And some of the sectors that I know that we may talk about, whether that's oil and gas or mining, have actually also provided a lot of defence in portfolios because they've been beneficiaries of higher prices.
Thank you. And we've got some excellent live questions coming in. Thank you for that. Are you planning on reducing bond exposure as a result of interest rates rising? This one, I think we do, if you want to take it.
So rising interest rates, bond prices move in the opposite direction to interest rates. So if interest rates, as we've just said, are expected to rise, then we'd expect bond prices to fall as a result. However, one of our jobs as an investment manager is to consider the relative merits of the different types of assets that we can invest in. And as we just said, we feel that the outlook for shares, for equities, is actually worse than it is for bonds. So we're likely to keep we've just increased our allocation to bonds, and we're likely to keep that increased allocation until we feel the outlook for companies and for shares improves to the extent that it actually makes sense to reduce our bond allocation and move the money back into shares. So that's something we're always wrestling with and considering when we're looking at the allocations between different assets in our portfolios.
And also the bonds that we're actually buying in portfolios are short duration bonds. They've got a short maturity, which means that the actual price risk that we're running is reasonably low. If interest rates do continue to rise, the bonds mature and we then reinvest at those higher interest rates. We also have material amounts of portfolios invested in index-linked bonds as well. So if inflation continues to be a problem, inflation expectations then rise, looking out into the future, and those bonds continue to benefit.
Thank you. So, Tim, another live question. In view of our heavy indebtedness, isn't there some benefit from inflation in the long run?
Yes, obviously in the West, we've been living well beyond our means, really for decades now. And that is only demonstrated by the fact governments continuing to borrow increasing amounts of money to provide the services they need to the countries. And ultimately, without inflation, it can reasonably be argued it's very difficult to even balance the books, let alone starting to pay back what you've already borrowed. And therefore, it's long been commented upon that the only way to try and reduce the debt burden is to try and inflate it away. And there is merit in that. There is historic precedent for that as well. However, it's the damage that is done to the economy when inflation runs out of control. And yes, okay, the debt at that point becomes worth, in real terms, a lot less. But there's a huge amount of damage that gets done to the economy in the meantime if inflation runs out of control and continues to run out of control. And it's not something that is sustainable. The worst example has been hyperinflation, whether that was through Wehrmacht or Zimbabwe, where people were wandering around with wheelbarrows of cash, but they weren't actually worth anything. That is not a scenario that any country wants to get itself into. So central banks have a major role in making sure inflation does come under control. Inflation at 3 or 4% is really manageable. Beyond that, it's getting dangerous.
Thank you. Jamie, this question to you. How is the current economic climate impacting the investments within the smaller companies fund? And have you made any significant changes to the portfolio? I
mean, certainly the smaller companies fund, it does what it says on the tin. It's 100% invested in equities in smaller companies. And so clearly this year, whilst equity markets have been weaker, the smaller companies fund has been more dramatically affected by that equity market weakness than mixed asset portfolios like the balance fund and the income fund. And it's fair to say that some of the small companies that we invest in are in Europe. They might have been disproportionately affected by what's going on in the, with the war in Ukraine. And so it has been a more difficult time for smaller companies. I suppose we take a very long-term view in our investments in the smaller companies fund. And these are companies which we think have really quite high growth potential. And so over the long term, 5 years plus, we expect these companies to do very well. But clearly in the short term, it's going to be a sort of rockier ride. So we haven't fundamentally changed anything in how we select the investments, and continue to really make small changes to the portfolio when we think, you know, the longer term investment case for a company has degraded. But otherwise, we still continue to select companies which you know, have good, we believe, long-term growth prospects, good management teams, sound balance sheets, and ultimately we think that can deliver over the long term. I don't know if anyone else wants to comment on that at all.
I was just going to just remind the audience that the Smaller Companies Fund only invests in profitable companies. There's lots of really interesting technologies out there, new products, new services, but part of our criteria is that all of those smaller companies are actually profitable. So sometimes we'll follow companies for a number of years until we feel that they meet our criteria for the Smaller Companies Fund. I think also, you know, we're still looking at some of the companies on our watch list. So we have a watch list as well as the companies already in portfolios and the funds. And some of those companies had become really expensive. And so they're becoming a little bit more attractive because we can take that long-term view, but, you know, it's a case by case, and, you know, how does that fit within the portfolio? Because we like to have a good spread, we like to have some diversification there in terms of sectors and regions and currencies as well, even though we don't have the bonds and the gold.
Thank you. And the next question to Liz as well, if you don't mind. What are your views on cryptocurrencies?
Okay, so cryptocurrencies, people may have heard of Bitcoin. There's a whole sort of range of different cryptocurrencies. So in terms of is it something in the client's portfolios or in the funds, the answer is no. It is something that we've considered and we've discussed quite widely. But for us, we have to weigh up the options of different asset classes. We've spoken about the bonds and the golds and the equities and the different roles that they play. So I know that some people have speculated that Bitcoin is another diversifier. It potentially offers a safe haven. I think we would challenge that view. And there are really two big fundamental issues that we would have with investing in any cryptocurrency. One is that the whole process, the computing part that's required to kind of manage these cryptocurrencies is really, really intense. So they're actually quite damaging for the environment because they use so much energy. And also there's a lack of transparency. So again, there have been issues with cryptocurrencies being used to kind of launder money and things like that, which would be a risk that we wouldn't want to get involved in. So for now, it's not in the funds, it's not in the portfolios, but, you know, we're very aware of it. And the technology that sits behind there is something called blockchain. And that is used in different sectors. So in terms of biometric identification things. So in India, for a number of years, they've been building up a system called Aadhaar, which has a number of issues that they've come across. But that blockchain technology can be quite useful. Also in food security and traceability. So, you know, if there's a kind of outbreak of food poisoning, the ability to trace it back to a single source. There's some investigation of using that blockchain technology behind the scenes. Sorry, that's a rather longer answer.
Very interesting. I will move on though to Jamie for a question. Gosh, it's our 11th question this morning. And this has been asked concerning ethical grounds for investing. So basically, can you explain the ethical grounds for investing in oil and gas companies and mining companies?
Okay. I think insofar as the ethical grounds for investing in oil and gas, clearly there are a range of views. You know, knowing the damage that carbon emissions are doing to the planet, some would say that we shouldn't be investing in oil and gas at all. I think on the other hand, accepting that oil and gas is still a vital source of energy and a raw material in a world where we're already beholden to sourcing our oil and gas from petrostates like Russia and Saudi Arabia. Some would say, we should be supporting investments in independent oil and gas companies that are acting responsibly. So at the moment, we take that view, but we're very careful to only invest in oil and gas companies that we believe to be operating responsibly, and so that means addressing their own carbon emissions and gradually pivoting their business away from oil and gas to renewable energy and low carbon technologies. So we're comfortable at the moment that Shell and Total fit that bill, and so we remain invested in both of those companies currently. But it's very much something that we're watching closely. And as Guido said earlier, we prefer to act as concerned shareholders. And so if we feel, as we have done in the past, on occasion, Shell or Total aren't moving quickly enough, we will engage with the company and we will make our position known. When we do that collectively with other investment managers, we can actually have an impact on the companies themselves.
Thank you.
I was going to add on mining. Sorry, I forgot. I think very briefly, the same issues exist on mining. We're going to rely on lithium, on cobalt, on nickel, on all of these materials for the energy transition. And so, essentially, we're prepared to invest in those companies as long as we see evidence and are reassured that mining companies are investing responsibly. And in fact, we've actually just made a recent investment in a company called FL Schmidt, and they actually supply services and equipment into the mining industry, many of which are specifically designed to help those companies reduce their carbon emissions. So there's lots of ways you can play these themes, and you can certainly do it in a way we're comfortable we can do it in a way which we think is responsible and ethical.
Thank you. Guido, this is a follow-up that's come in. Has the North Sea windfall tax had any influence on your investment decisions?
So the short answer is yes, it's something we've considered as the tax environment in which all of our companies operate. It's one of the considerations that feeds into our investment process. A windfall tax is something that we've looked at, and the potential impact on the actual businesses such as SSE and Shell and Total that we've mentioned before. But fundamentally, it comes back to the business and where are those businesses making their investments, and are those investments in areas such as green technology, renewable energy, carbon capture, that ultimately there's going to be a long-term demand for. And tax regimes will come and go, and our job is to look through them almost, particularly for one-off windfall taxes, and understand how are the businesses we're investing in going to operate going forward over the long term, and are they going to be at a very basic level sustainable? Are they financially viable over that sort of period of time? And if tax legislation changes, then we'll reassess the situation and all the investments that it impacts, and go back to the fundamentals. And again, we may well have to sell something if it impacts in such a material way that business model we no longer feel is viable.
I think politically as well, governments have to be careful that what is politically expedient at the time by way of a windfall tax, and obviously energy companies that seem to be profiteering, ultimately could damage potential longer term investment in a country like the UK as a result of companies saying, well, we could go in, we could invest a lot, but if we suddenly do well and make good profits, it might just be removed from us. So politically, it creates a more volatile environment and makes that decision-making process for companies a little bit harder.
Thank you. And Tim, this one for you. It's been asked before, but it remains relevant. What would Scottish independence mean for McInroy Wood?
Well, there are really three ways, I suppose, it could impact upon us as a firm more widely. The first and most important, of course, is you, the clients and investors. And for those of you that are based in Scotland, Ultimately, it's what would happen to personal tax rates and regimes and how that affects you. There's not really much that we can do about that. The only thing that you can do is decide to move, which obviously one hopes wouldn't be necessary. The second is its impact on the firm as a whole, and obviously the biggest impact that could be Scottish independence could have there, other than new regulation, and nobody really needs more of that. There is really more around the corporate tax rate and the corporate tax environment. And while no doubt the Scottish government are politically inclined to have higher tax rates for higher earners, higher tax rates for businesses who don't necessarily have themselves a vote, it's actually very difficult for them to do in practice. The Scottish government have the power at the moment to raise taxes on individuals higher, and they've chosen to differ it by 1% at most levels, because anything else then would see a movement of labour from Scotland elsewhere. So even if they were allowed to do it to a greater extent than they are today and get control of them, for instance, company taxes, dividend taxes, inheritance tax, it's going to be difficult for them to differ substantially from the rest of the UK because we're so intertwined. And the final leg is how it might affect our employees and our ability to attract talent. And it really comes back to those same arguments about personal tax rates and how attractive Scotland is as a place to do business. So while politically, even if independence happens, and we hope it won't, but we'll just have to wait and see, even if it did happen, actually the ability in practical terms for any government in Scotland to differ substantially from the rest of the UK, I think, and still believe is limited.
Now we are heading towards the end of this morning's webinar, but we've still got time for a few more. Guido, can I ask you what percentage of the balanced fund is invested in fixed interest securities, and what is the average time duration of securities held? Would you not be better off holding all in cash or in very short-term deposits?
Okay, thank you, Ayla. So around about a quarter of the portfolio is invested in fixed interest securities. And that's a combination of, sorry, slightly higher than that. That's a combination of US dollars, of sterling bonds, so bonds invested in the UK government, and Swiss franc bonds. And they're all very short duration. So the average duration, so this is the time until they mature, is 3 years in the balanced fund. And that compares with the average time for UK government bonds to mature across all of the bonds that they've issued is over 10 years. So it's very short. And as Tim explained earlier on, one of the rationale behind that is we think interest rates are going to rise. And if once the bond matures, we're able to then take the proceeds and reinvest it back into something at a slightly higher interest rate. When we compare the bonds that we're investing in to cash or cash equivalents, we're not earning anything on cash in our portfolios. It's a zero interest rate effectively. But when we're investing into the government bonds, we are actually able to earn a little bit of interest. So it's giving us a bit of a return while we've got that insurance in our portfolios, which is always attractive. And I'd say the key for us is having a diversification of currencies. So they're there as insurance. When things don't go well in stock markets and global economies, as we saw back in March 2020, as we're seeing at the moment, investors tend to sell shares in companies because they're seen to be more risky and more volatile and look for somewhere safer to invest their money. And historically, that has tended to be the US government because the dollar is used to trade around the world and is therefore seen as a safe currency. And in places like Switzerland and Japan, for similar reasons, their currencies are seen to be safe havens. So that's the rationale for having those two particular currencies in our portfolios. In terms of the cash and the cash deposits, we do hold cash in our portfolios, but that's very much there for liquidity in terms of allowing us to actually manage the portfolios and funds on a day-to-day basis.
Thank you. And we'll try and get a few more in. Liz, this is to you. What message do you have for older investors who may have a different view of the long term?
Yes, so we do. We have a range of investors from young children who have junior ISAs right the way through to people who are even over 100. But there you go. So as a private client, so for individuals who are private clients, we meet with them at least once a year, and we have these discussions about, you know, their particular needs, and the needs of an individual do change over time, and that's part of the reason that we have that sort of dialogue with people. I mean, broadly speaking, we talk about clients having a minimum investment time horizon of 3 to 5 years. And obviously that feels a little bit different if you're a 20-year-old to if you're a 95-year-old. So it's really personal, I think, but we're fortunate that with healthcare developments and things, people are living longer. And, you know, we also encourage our clients to talk about the next generation, about their children, their grandchildren. You know, can we help them in any other way? So yes, it's very specific to individuals, but yeah, I understand where that question is coming from. It does make sense.
Thank you. And Jamie, just briefly, if you can, are there areas of the equity markets that you are looking at that might benefit from a higher inflation environment? Would you hold different types of stocks than you normally would?
I suppose we've been mindful of the risk of rising inflation for a number of years now, and I think probably we made some changes in portfolios really last year and into the autumn, not in the equity markets, I should say, but rather in, you know, the bond allocation, moving more into inflation-linked bonds and adding to our gold position. In terms of the equity markets, we're always mindful of inflation, because ultimately the companies that we invest in have to be able to pass on the rising cost of their raw materials to their customers. And so in any assessment we make, we're always looking at the quality of the products that are being sold, whether the company has pricing power, strong market share, for example. And I think if we continue to do that, then over the long term, those companies will be able to survive in an inflationary environment. There might be a lag where it takes a little bit of time, 3 months, 6 months, for them to catch up. But ultimately, you know, we would have the conviction in the companies that we invest in that they can do that. I guess we're short of time, but we should, you know, we've not made any dramatic swings and moved portfolios into real estate or into only into infrastructure. You know, we're continuing to do the job that we've done over the last 30 years.
Fantastic, thank you very much. Pretty good in such a short time. Guido, in a minute or less, would you like to wrap it up for this section? In light of what has been discussed, we've asked, what is the job of the investment manager? And that is our question, not one of ours.
So Isla, at McInroy, we believe that the role of the investment manager is to preserve our clients' and investors' investments in real terms, that is, against inflation. And we've talked about a range of different topics this morning. So where we invest in the world in different countries and different industries and different asset classes. And our job is, as an investment team, is to consider all the relative merits of those different types of investments. And depending on our view of the world, whether we're feeling more cautious, as we are at the moment, or whether we're feeling more bullish, adjusting the allocation to all of these different types of investment in order to ultimately try and protect against inflation. The second role that we're always conscious of is that we're stewards of our investors' and clients' money. And part of that is making sure that we act as concerned shareholders and engage with the companies in which we invest. And as I said at the outset, ultimately that means that the companies we're looking to invest in are high quality and are ones where the wider needs of society are taken into account, because that's where the sustainable returns over the long term are going to come from. And that's where we're going to be able to protect our clients' portfolios from inflation.
Thank you, Guido. Over to you, Tim.
Good. Well, I hope you found this morning's session useful. But as always, please do provide feedback to us, either on the content of what we do in these sessions, or indeed the means of communication with you as well, and your preferred means of doing that. So, but thank you for staying with us, and indeed for engaging as actively as you have. And I look forward to catching up with all of you, I hope, before too long. Thank you.